Welcome back, everyone, to Vox Markets Live. My name is Paul Hurr. I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott to discuss all things small cap. So welcome, Paul.
Thanks, Paul. Hello, everyone. I hope you can see I've got better audio and better vision. I've done a Temu haul and I got all these LED lights in front of me. Yeah.
Well, we just say you definitely look brighter and you sound brighter. So that's all we need. That's perfect. But we've had another really busy past week on all the corporate news flow. Plus, we've got the Bank of England interest rate decision tomorrow, with the bond market expecting a quarter point cut to 4%, which should hopefully be good for all the housing sector and interest rate sensitive industries. But we've always sort of run through some stocks this week. Have you been buying or selling anything over the last 7 days?
I topped up my position in 4 Imprint this morning, FOUR, where I think the stock should have gone up, but it went down. It seems to be Berenberg who are to blame for that, with a negative note that obviously we can't see. What else? I topped up another thing that's called CT Automotive, which is a nano cap thing. But if you read the update today and look at the fact that it's on a PE of less than 4, the valuation doesn't make sense to me. So it's an existing holding that I've just bought a few more of. Very small, quite illiquid. So not. What does
it do, Paul? Is it something like interior? If I remember, is it interiors of cars or something like that?
Yeah, there's more to it than there seems. I think if you watch the webinars from the company, it's actually quite a lot more specialized. Yeah, it makes it operates factories in low cost areas such as Mexico, where it's benefiting from it announced a load of big orders this morning as well. Something I think they're a beneficiary of tariffs. Basically the business is it said it's in line to make about $10.5 million profit. And the market cap's only about 25 million quid. It just looks the wrong price to me, but that's because of the history of it. It disappointed after the float originally had to do an emergency fundraise. So it's got a checkered past, but it's now seems to be firing on all cylinders. And the management webinar they did a little while ago pointed out that there's a lot more barriers to entries to selling components into car manufacturers than people might think. So, and the margins are rising as well. Gross margin it announced this morning. So have a look at it if you do get involved in, the real tiny things. You've obviously then got illiquidity and widespread. So probably wouldn't suit you, Paul.
Well, you certainly sent the shares up 11% today, so you've done pretty well there.
That wasn't me. That was the trading update.
No, I'm sure it wasn't you. Is it in terms of USPs? Has it got any sort of pricing power other than obviously it's got a very good infrastructure and a reputation, which are good barriers to entry?
Well, it seems to. As I say, I would have thought, to a penny manufacturing parts for cars, and it's a lot of these sort of interior fixtures and fittings and things like that. But apparently, it's a lot more specialised than you might think. There are barriers to entry, and they also use AI extensively in the design process, which again they demonstrated in the last webinar. They showed some examples of it. I just think it's one of those things that it's worth people doing a bit more digging into, and you might like it. But as always, never a recommendation. Just and I hold a few myself, and I doubled my position this morning.
Good idea. Anything else you've been buying or selling at all? You've got obviously 4 imprints, CT Automotive, and anything else?
Not personally, no. I don't tend to make many adjustments to my portfolio. I mean, obviously, the FA Cup, as you might call it, for me was me selling Zotefoams a couple of weeks, and then it put out the one eventuality I didn't anticipate was that it would put a brilliant update out saying ahead of expectations. But because what I wanted to do was sit out the announcement and then buy back in. Spectacularly failed.
let's review the Zotefoams one, because we've got a number of people asking. Dave from ION is asking about it. It basically makes specialty foams, isn't it, which go into sportswear. I think his biggest customer is Nike, and it also had it inked a deal, I think, a joint venture with a local manufacturer of shoes in Asia, in Vietnam, I think. But anyway, what was your take on it? Because the shares responded really well, didn't they?
Yeah, it was very positive. I mean, as I say, for me, it was just purely a risk-driven thing. It was 5 times geared in a highly geared account a small account that I use. So I just wanted to sit out the results. But looking at the chart, that cost, but such is life. It's just one of those things. It was a risk management decision. It wasn't because my opinion of the company had changed at all. We've been green on this one 5 or 6 times this year. We like it a great deal. And yeah, I thought the update was it H1 results. I think. Just bit my tongue.
Oh, yeah, I think they upgraded. Yeah, they upgraded their numbers, didn't they?
They did. They upgraded the numbers. The balance sheet's fine, but there will be a lot of capex in the coming year. But as you say, they've partnered with a South Korean giant that also has operations in Vietnam to spread some of the risk. So I like that for the new facility they're building in Vietnam. I think everything's going great. I mean, you look at the announcement and the figures, they're benefiting from 2 things: the cessation of the resource project, which was stopped, and also a favorable tax charge. So you do have to take those into account. But I mean, given that we're hearing from almost everyone else how tough macro is, I thought these were fabulous figures. And it's still not expensive, even after that vertical rise in the last 2 days, still good value. So yeah, I'm still very positive on it.
Yeah, I mean, you just say it's less than 12 times PE, and obviously the turnover is doing well with and it's de-risked that new plant it's building out in Vietnam. What level? How would you view it? I mean, obviously you're sort of kicking yourself a bit in terms of having sold before, but frankly, would you go back in at 12 times? Because I wouldn't say the valuation is so expensive. It's in terms of stopping people, yourself going back in. Well, I mean, how do you sort of position it, having owned it, liked it, and only basically, and the rest, sold because of the risk management situation?
Yeah, I mean, if I was just running a long-only long-term portfolio, yes, I wouldn't have any qualms at all about buying now. However, what I would say is that in the current market, things tend to do vertical rises and then they just start to drift, So I think personally, I'm not going to pay £3.50, not because I sold at £3, but because I think I can probably get it cheaper as people get bored, the momentum runs out and it drifts back down again, because that's what everything else is doing, isn't it?
Yeah, no, exactly right. Got a follow up from Zoo. Look on CT Automotive. He says the tax charge is not right, so it may not look as cheap as as it appears on first measure. So you might find he reckons it isn't a straight normal 25% tax rate, but
that could well be right. Yeah, I mean, I was valuing it on a multiple of the pre-tax figure, and it's very cheap on that. I think you got he could well be right.
Okay,
but it's still dirt cheap.
Yeah, good. Okay, good spot, Zulik. Just on one that I've bought, just for disclosure, I've added to my existing position, which I've been talking about for some time, in Eagle Eye, because I only got a third of the position. Yeah, I bought this week at about the same price, about 231. I think it's about 229 now. I'll still be adding over the next month, or just to try and it's not that liquid, to be honest. But
no.
The reason why, as I mentioned to him, why I like it is largely because the technology is very sticky. It does these promotional discount software go into grocers, and it's inked this fabulous or potentially fabulous deal with SAP, who will lift and shift its software and incorporate it within its tech stack and then sell it to all its grocers around the world. Now, obviously, the valuation depends on that, but it did have a big kick in the proverbial by losing a large contract. In fact, its biggest client out in the States about 2 months ago, which led to that sort of profit warning. But just as a disclosure, and it's still not. It depends if you look at it on a profit multiple, which you do, and then it's dead expensive. But if you look at it on a sales multiple, an opportunity multiple, given the 80-90% gross margins, it's still I think it's only about 1.3, 1.4 times sales. So it's very, for a software company with potential. If it can get back to its swagger, so to speak, then it should do well. But
it's basically delayed the bull story by about 2 years, hasn't it? Effectively losing. I can't decide on this one. I take on board everything you say about it on the bull side, and I accept those points. But I can't quite push the button myself. I tell you one that we've talked about. Sorry to go off agenda, but
yes, please do.
one that's drifted back into buying range actually is Tracsis.
Yeah.
We both bought those near the lows, and then we were absolutely astonished at it going up 50% in short order. So we both sold them, even though we hadn't planned on doing so.
Yeah.
And we fully disclosed it all in these videos. And it's come most of the way back down again, isn't it? So are you tempted to have a second go at that one, Paul?
Yeah, just for everybody, this basically does software and tech services for the rail industry, particularly in the UK, to network rail and also to the network operators, the franchises, and out into the States. And it's got some fantastic tap and go software that's selling into network rail. Hopefully going to, well, they are deploying it over the next 5 years. But they've been through a number of sort of profit warnings, and as Paul says, we've both bought it. Yes, and the answer to come back into your question, Paul, is absolutely. I think this is really getting interesting. And what I would like to hear that would stop me just getting in at the moment, because we both interviewed Caudal, you know, the other one in the which does which does track maintenance, and they've got that brilliant US, and I can't remember. It's a safety grade which has been level of software that's been mandated across the US. Anyway, they do sort of like say, but they did say that the rail industry, and Tracsis has already said that it's still slow at the moment with CP7, which is the UK rollout. So I would just like to see a bit of light before I steam in again. But I do think it's interesting. What about, is it an interesting area for you as well, Paul?
It is. I did on Friday, I did a sort of market screen, and I came up with all sorts of interesting shares that have got a chart exactly the same shape as Tracsis, basically. That have had a huge run up from April through to about June, and have now come most of the way back down again. So I'm looking at things like War Paint, that's come back a lot. B&M Stores is very cheap. You know, they're absolutely list as long as my arm, and Tracsis came up on that list as well. So I think we're getting a second bite of the cake here with some real decent companies on cheap valuations again.
Yeah, good. Okay, well, let's move to another one, which could be is on a deep valuation, but you've got to be it's one for the brave, should we say. Peter is asking about Videndum, which has just been bought industry by I think it's Richard Staveley in the Harwood stable about a month ago. But anyway, they came out with a 40%. Well, basically the shares are down 40% today. With another profit warning, and I think people are worried about the balance sheet. What was your take on it? But it is as you would class, a profit warning of the day.
It is. I mean, I don't like to kick things when they're down, really, but we've covered this stock 5 or 6 times this year, and we've been red on it. We've been really ringing the alarm bells on it, saying, look, you know, the debt is way too high, and I think this could be a potential zero now. I would personally, if it was me, I'd sell at any price, because if you read the detail of the going concern statement today, it's not just a profit warning. They're basically saying it's looking unlikely that we'll be able to agree amendments to the bank facilities, which is basically telling you that this thing, I think it's almost certainly going to have to do a deeply discounted equity raise. I think it's in big trouble. So personally, I wouldn't go near it at any price. You know, it wouldn't surprise me if you get a 10p emergency placing here. I don't want to scaremonger, but just read the detail of the going concern statement. Read what they said today, and if it doesn't set alarm bells ringing, something's wrong. So far too dangerous. These types of things, I think sometimes you can take a risk and you can say, okay, if it works out, it's a 5-bagger. You know, and I think that's probably what the bulls are thinking with Videndum. But I think the trading news today was so bad, and the outlook really bad, and the bank position just looks like it's teetering on the brink. So I think risk reward now is terrible on it. I wouldn't go near it. Have you looked? Did you read today's announcement, Paul?
I saw the headlines. I was just trying to work out how much I think they might need to raise to get back within the banking covenants, you know, for the bank to get. And I was just doing the numbers and looking at I think they're about 110 million net bank debt. Okay, and they're looking at, I think, about 31 million of EBITDA. So if you did, they're currently on just, well, basically, it's
you sure that doesn't sound right to me.
They're on I think it's 31. I've got 31 EBITDA on 110 million. Basically net debt. So that's basically 3.5 times net EBITDA.
I don't think that's right,
isn't it?
No,
okay.
I think that's got to be wrong, Paul. Because I'm just calling up the forecasts. Where are you getting that 30 million EBITDA from? Because remember, it's warned on profit today. So
I got it. I got it basically. It could well be way out of date. But I was just
that's the old EBITDA forecast, Paul. I've got that as 31 million as the consensus yesterday. But of course, that will be coming right down today because they've just issued a big profit warning. So no, I think that's wrong. I think it's all. I mean, it's chapter and verses in today's announcement about the bank facilities where they say they don't think they'll be able to reach an agreement with the bank. So I mean, that's the worst case.
Okay, so let's just say for instance they're going to do 20 million of EBITDA then, or 25. Let's say for argument's sake 25 million of EBITDA as an ongoing with a bit of cost savings, whatever. So that'll be 4.5 times. Now I think the bank will say to them, you're going to have to get down to at least 2.5 times EBITDA, given it's the cyclical industry. Okay, so that basis, they're going to have to basically raise at least 50 million. And on a 50 million, their market
that was the sort of figure I had in my head,
And the market cap's only 65. So you're looking at a really hard dilution, aren't you? You're looking at basically another almost a complete number. 80% of the existing shares are going to have to be reissued, and that would be at this price to get down to an acceptable EBITDA, and it's likely to be at a discount. So you're right. You're probably looking at 100% dilution, aren't you, on an equity raise to get it back within acceptable bank terms?
Minimum. I think that's an optimistic view. I think it looks to me just like the sort of situation where the people who are going to put the money in will just call the shots. They can name their price. I mean, like I say, I wouldn't be surprised if it's 10p for a placing. Because where else do they go? They've got to move quickly. They've pretty much told the market today we're almost bust. So I really do think people must read the detail in today's announcement because it's severely bad.
Okay, on the same vein, we've got another one for the brave. We've got Synthomer, which is basically the specialty chemicals company, which I think is in the same boat. It came out with a profit warning about 2 days ago, and it's got a EBITDA to net debt ratio. I think they published it of about 4.8. They haven't got imminent debt problems in terms of having to repay, but I think they've been having to be repaid in about 18 months' time. How do you view this one? Again, really, some pretty smart investors are in here, but again, you've got to be pretty thick-skinned to trade.
It surprises me the balance sheet risk that people do take. Like you say, even the big and the shrewd investors. We covered this one yesterday. Sorry, I'm just trying to find my internet's a bit slow. Yeah, we're amber red on this, so that is moderately negative. My colleague Dave wrote a section on it. I mean, we've been warning on this one for about a year, just saying, look, it's got way too much debt, and every trading update just gets worse and worse, it seems to me. So we're very negative on this one as well. Not as negative as Videndum. I mean, Videndum is basically said we're teetering on the brink, whereas Synthomer or whatever it is. Further cost cutting they're doing. Here we are. I mean, the net debt, and this is excluding leases, is 638 million. That's insane. This is for a business that's only trading around break even currently.
Market cap's only 100 million as well.
Rightly so, which is telling you, isn't it, that the equity is just a stub, really. So, I mean, again, with this one, I think you've got more chance of a multi-bagging outcome than Videndum. So for risk takers, of the two, I wouldn't touch Videndum at any price, but Synthomer, you might be able to, you might get if you do need a remarkable turnaround at Synthomer, and it said that I don't think there was actually any sign of that in the trading update, was there?
No, still tough trading. You're right, exactly. Going in destocking and specialty chemicals. I mean, it relies really on improving GDP around the world and industrial operations, I think.
Yeah, and if you look at the chart as well on Synthomer, it peaked at £41 in 2021. It's now 64p. I mean, that is staggering, isn't it? And it's got all this debt. So I think this was a case where reckless management did stupid acquisitions on money they couldn't afford to borrow, and this is the end result, isn't it?
Yeah, no, I've got actually, 2021, it was £105 up there.
Oh, I think it must have done some. Oh, why have I got four? Oh, when was that? 2021.
2021, yeah, and then back in
I've got 40.
Anyway,
maybe it did a share split or something. I don't know, but
yeah, no, pretty bad. Okay, another stock that was asked about, Adam, is in terms of the motor finance commissions. Obviously, we've had, in the same breath, they were a really risky area. We've got Close Brothers, which has obviously rallied hugely. And so at one point, people wrote that one off, and people have done very well out of it. And it's really, is there any more juice still in the tank? Because I think it still trades at less than net tangible assets. The investment bank, and it does.
Oh yeah, well below.
Yeah, it does financing. We did for the motor industry, and so therefore it was hit by it. But the shares have rallied really well if you were brave to go in at the bottom.
Yeah, I mean, it was a punt, wasn't it, at the bottom, and unless you had inside information about the court case, in which case you shouldn't have actually been dealing in it at all. But yeah, no, I mean, people who took a punt on it, and I remember at the lows, there was a gigantic, such a huge discount to net tangible asset value. The net tangible asset value is about £1.5 billion, and since then it's sold off its investment arm, hasn't it, and sold off Winter Floods, I think, for about 100 million. Yeah. All to raise cash for the worst case scenario. But no, I mean, it's looking much, much better now, isn't it? For sure. Still at a discount. So I actually think, assuming there's no more sort of sting in the tail from the car finance thing, because we're getting conflicting messages about that, aren't we? It's still trading about half net tangible asset value. So I can see why people would be motivated to actually hold on to it now. Now the worst case scenario seems to have been knocked on the head. But well done to people who made a bobble to on it. That's what it's all about, isn't it?
Yeah. No, I mean, I'm with you. I think, it's rallied a lot, but it can still go further, I think, and, if you are prepared to take as you say, a bit of a punt, then you can get some good returns. But equally, you've got to be prepared to lose all your money as well, haven't you?
Well, not so much now. I think, 2 or 3 months ago, that was the case. But risk reward definitely seems to move in its favour, doesn't it? So I think people who have the nerve to assess this non-emotionally, and just look at that sort of, I think at one point it was about an 80% discount to net tangible asset value, wasn't it? I think they've been rewarded justifiably. Yeah, because they didn't just gamble on it. They could weigh it up and say, I think I did buy some at one point around £2.60 and then panicked about 3 or 4 weeks later and sold them for the same price. Usual stuff with me, isn't it?
Oh, never mind. Okay, we've got David Raywood, just switching sectors back to software. He's asking about Auction Technology Group, which basically does auction software for auction houses and brings buyers and sellers from around the world together, largely focusing on 2 main industries. One is the antiques and collectibles, where it makes, I think, quite high commissions. And then it's got more of the sort of the industrial and commercial equipment that it also sells with lower margin. Anyway, it came with a bit of profit warning. The margins, EBITDA, were going down. And then also announced it'd done an acquisition for about $85 million of a competitor out in the States that does collectibles and I think it was chair something or other that does basically antiques and furniture and stuff like that. More on the list price rather than auctions. Anyway, what was your take on Auction Tech? The shares have really responded poorly to the update.
Yeah, it's hit a new all-time low, I think, today, hasn't it? I mean, it's again one of these former darlings that is now valued as it's a value share now. PE of about 13. Yeah, we were cross with the company for kind of slipping out a profit warning in the last sentence of a long-winded announcement about this acquisition. So now the acquisition, I think, is imprudent because the balance sheet is already weak at Auction Technology, minus $127 million. And they're now announcing a substantial acquisition for $85 million, which will be mainly goodwill. So that'll take their balance sheet probably down to about minus $200 million, which is a big chunk. So I've never been keen on this share at all, but I mean, I wonder if it could, because the trouble is it's struggling to get any growth and its margins are under pressure because there is competition in this online auction space. I don't think it's as sticky as people might like to believe. So I'm not keen. But I wonder if, I know you know it better than I do, so I wonder if somebody might bid for it, do you think, Paul?
Yeah, I think private equity would definitely be interested in picking up the business. It does actually generate quite a lot of cash. The one thing I didn't quite follow, though, in terms of the strategy for the acquisition, was I think the business that it's bought does largely basically fixed prices. So you on eBay, it has the auctions and then it has buy now or whatever it is. I think this one does more the buy now, and it's sort of supposed to be curated collectibles and furniture that has a certain price so people can go onto it. But then that sort of takes it away from the auction houses, because the auction houses, they're not going to make any money on a list price. It just turned into a retailer. You lose that sort of like level of exclusivity. So I'm not 100% sure how that sits. It sits well with eBay, which is basically just a flea market, and you just go in there and buy low value. But when you look at curated products with a list price, I mean, obviously they're brighter than I am, so I don't know, but it'd just be a bit confusing to me, because I could see somebody valuing this, if they're not careful, on a retailer multiple rather than on a software platform multiple, because it's just basically it's effectively selling its somebody else's kit at a price. It's not dissimilar to eBay, and eBay, I think eBay trades at about 12 or 13 times PE, so it's not exactly highly valued. Yeah,
you could well be right. I think thinking back to a couple of reader comments on my Substack, I think somebody was involved in this space, and I think they said that Auction Technology got greedy and they were trying to sell lots of add-ons that customers didn't really want, and that then pushes the commission up to, I don't know, 7-8% or something. It gets to a level where the end customers are motivated to bypass it. So I think maybe they've tried to be a bit too clever, but it just doesn't appeal to me because it looks pretty much ex-growth now.
Yeah. No, it's good point. Good point. Okay, we've got a couple of people. We've got Tweed Scott and Lemon Physical both asking about Tortilla Mexican grill, which I know nothing about, but apparently you're an expert. You've done lots of sort of like mystery testing of their tacos, I guess.
Yeah, they're not bad. I like it. The CFO became the CEO, and he seems to have lots of fresh ideas. I think the downsides, to get those out the way first, and I must thank my reader Annette, who flagged up to me that put a trading update out this morning, past the usual 7:30 window, so I missed it. So thank you, Annette. I do hold a small position in this personally, because I think it is beating the industry averages on like-for-like sales, although there was a slight slowdown from Q1 to Q2. But they're getting enough like-for-like sales growth, I think, of 4 or 5% to mop up the increased labour costs that are obviously plaguing the sector. They said today they were in line, but the UK, the core UK operation is I think making about 2.4 million EBITDA. I think that was the figure I remember in H1, which is not bad. And that does actually equate to cash flow because it's on the old basis of EBITDA, not the silly new basis. But then it brought up a French chain that it's trying to rebrand. That is a bit of a drain. That's losing, I think, 1.2 million in H1. And they've got CapEx. So I do wonder if they've bitten off more than they could chew. And they've got bank debt, I think, with Santander, just under 10 million, which for the size of business, I think they've been a little bit too ambitious and introduced a bit too much risk. But so that's why I'm keeping my position small. But I think they're very ambitious, and I think this is it's succeeding. It's outperforming the market. The product's healthy-ish. It's quite nice. So a very, very cheap market cap. So if they can digest this French acquisition without having to do an equity raise, then I think we could do well on this.
Yeah. What's the like-for-likes, did you say, on it? The sales, like-for-like sales?
4 or 5%.
Okay, that's not bad.
Which
That's all right.
is good. Yeah, that's
Yeah.
ahead of Greg's, for example, isn't it? I think.
Yeah, it is. Yeah, good. Okay, on the same vein, we've got a couple of questions on Domino's Pizza, which is basically again an old darling based that was a franchise from the States, and then they franchise out their stores. Probably got about 1,500 stores, shops in the UK. They've got a bit, seem to be ex-growth, and they're looking for another brand to incorporate within that particular group. What was your take on it? It's now getting to be value territory, Domino's.
Yeah, well, that was exactly my conclusion too. Getting into value territory. By instinct, I'm essentially a value investor, really, although I don't follow my own rules half the time.
Yeah.
So yeah, we looked at it. When was this? Tuesday, yesterday. That's right. It dropped about 16%. Only just over £2 now on H1 results with a profit warning. But the profit warning wasn't that bad. It was only guiding EBITDA 7% lower than the previous EBITDA. Although you do have to remember that that magnifies when it gets down to earnings per share. This is why companies like quoting EBITDA guidance has been reduced, because it sounds better than it would do if they quoted the earnings per share, because there's more leverage the lower down you go effectively. Still a highly profitable business. Weak balance sheet though. They've done this thing that so many mid and large caps do, of taking on debt to juice up the investor returns when debt was cheap. And now they've got 266 million of net debt, which I think is too high. But you're getting a decent divvy here. I think, am I right in thinking the divvy yield is about 5%, Paul? I think that's right.
Yeah, it is 5.4%. Yeah, and 11
which is pretty good.
11.2 times PE.
Yeah, so it could be again similar to some of the other shares we talked about before. It looks like one of these former darlings, growth things that was on a PE of 20 or 30 for years and years and years. That's now just re-rated down to a value ex-growth type of share. Well, I find those quite attractive, particularly if you're getting a 5.5% yields. You know, I do wonder, maybe the weight loss jabs, maybe health concerns might be meaning that there's an underlying and maybe getting a lot worse in future demand for people to stuff their faces with cheese on toast effectively.
Get that stuffed crust going.
Yeah. What do you think? Do you think these weight loss jabs are having some effect, Paul?
They are in the States at the margin, definitely.
Okay.
How much? Yeah, there's lots and lots of people who are on it. Something like, I don't know, 20% or 10% of the population. So it certainly is impacting some of the fast food restaurants there. How much in the UK? I'm not sure, because obviously the NHS is not paying for them. It's all private prescription. I actually think it's a very crowded area, pizza. I mean, let's be clear about it. Pizza restaurants and, you know, takeaway pizzas. And this, and again, the supermarkets, I'd hate to say it's a horrible pun, are eating their lunch. You know, I mean, you look at the amount of sort of like, you know, fresh pizzas and frozen pizzas you can get down the supermarket. They're also impacting likes of Greg's. I just think, yeah, go on.
I was just going to say that you're undoubtedly right on those points, but you know, nothing beats a Domino's pizza when they arrive. Their standout points, though, Paul, is that they always arrive absolutely piping hot. You know, whereas most other takeaways don't. And as you can see, I'm a pizza connoisseur, and you know, they are absolutely delicious, aren't they? And the deals are quite good. The special offers. So I definitely wouldn't write off Domino's. And I think on a PE, 11-ish or something with a 5.5% yield, I think maybe you'll see that transition from growth investors giving up and value investors gradually moving in. So I think it's worth having on our watch list. Yeah.
Yeah, no, it's not expensive, pays a good dividend. So, and if it can wrap in a second brand into a franchise model, then that could really change the business. I mean, you saw that happen with Cake Box, didn't you? Because they've bought Ambala Foods, and the share price has responded very favourably, because they can then just do the same with a different or complementary.
Yeah, I hadn't thought about that, because there's another franchise business, isn't there? Franchise Brands, which does exactly that. It has a 6 or 7, maybe more, unique separate businesses, and it sort of puts them onto its platform. But maybe Domino's could do something similar, and they did indicate, didn't they? I think that's where you got that idea from. They did moot this idea of buying another brand, didn't they? But the franchise brands is a B2B brands, whereas obviously
Cake Box is B2C, and Domino's is B2C as well. Okay, Let's move on. We've got Mike. He's asking about Yougov, that I think came out with an inline trading update, and the shares shot up sort of like 10-15% on a relief rally, I imagine. But what's your outlook for Yougov? Still quite a tough market competing against the big sort of tech giants in providing information, though, I imagine.
Yeah, we had a look at this yesterday. I think relief rally was how I described it as well, in my report and my podcast. I think, things have basically, it's been through a terrible patch over several years. And the business has stabilized basically. And it did that very large acquisition, didn't it, which messed up its balance sheet considerably. So this one, again, has balance sheet issues. But I think the CEO was replaced, wasn't he, 6 or 12 months ago, roughly. And it looks to me as if it's stabilizing. It's not getting any worse. And you have actually got a nicely profitable business there. But they did say yesterday that client budgets were still under pressure. And I think this is one where you might want to comment. You know a lot more about it than me, whether AI is going to help or hinder companies like Yougov.
Yeah, I think it's definitely going to hinder it. I mean, I'm using Chat GPT all the time now. It saves me, it's hugely efficient, saves me a lot of time and effort. And where I can get information, anything which is a so-called inverted commas platform that provides information, unless they've got a lock and key round it that nobody else can get and it's totally proprietary, then they are going to struggle. And Yougov, what their modus operandi is, providing data insights. It's utilizing that huge consumer panel that they have, about 13 million people, to get insights into brands. Well, frankly, the sophistication of Chat GPT and how it links into the social media channels and scrapes them, I don't know. It wouldn't be an area that I would rush into. It has been a darling and has got an excellent brand and is good, obviously, for the elections. But I personally treat this as a bit of a value trap. Actually, it trades at about just over 9 times PE, so it's not expensive. But like Future, I would not be rushing into it myself anyway.
No, but again, you've got to combine that low PE with a horribly geared up negative balance sheet. So you're not going to get any decent. It's not like, say, Domino's, where you're going to get 5.5% divvies. I don't know if Yougov is paying divvies, but if it is, there won't be very much because of that geared up balance sheet. So I think it's potentially interesting. But again, I wouldn't be surprised, like so many other things at the moment, when they shoot up 17% on a relief rally, normally it peters out and they just start drifting back down again. So I would personally just give it a few weeks and see if it comes back down again, and maybe nibble a few, but it wouldn't be with any conviction for me personally.
Yeah, good. Okay, we've got Ben Sharman. He's asking about TP ICAP, the interdealer broker. They came out with some results today that I think were in line, in fact, quite strong. They'd benefit from all the Forex and the market volatility as people were dealing and stuff. But the shares on an inline statement are down 8% today. The question is, what's happening to the share price?
It's the same with 4Imprint. They put out good numbers, inline outlook, and it drops 10%. Crazy. It's not. It's a very odd market at the moment. What's it called? TCIP, isn't it? I had a very one of the readers said to me, "Have a look at it, Paul." So I literally only spent 10 minutes on it this morning. I like the dividends. They've got generous dividends there. Balance sheet's not great. It's funded with 3 circa 200 million, 250 million each bonds. And if you look at the percentage interest rates on them, they're going up a lot. It's now having to pay 6-7% interest rate on its borrowings, where the older bond was 2 3/4 or something. So that's worth bearing in mind. It looks a lovely business, highly profitable. It's some sort of intermediary dealer, isn't it? I don't really understand what it does. Financial sector.
Yeah, it's an interdealer broker, which basically means that it takes trades. It serves its customers are largely hedge fund managers and banks, and it takes large blocks, whether it's largely interest. They're usually derivatives, so they're interest rate futures or forwards or whatever like that, and then sells it on to other parties and takes a clip in between. So that's basically what it does. It's highly regulated. It's got this division called Parameter, which collects all that data, which is basically off exchange data, which is highly proprietary, and they're trying to list it in the US. And my take on it is that they've got another, because of the volatility, it's delayed that IPO of Parameter Solutions in the States. I think that's what investors who have been buying into the story want this one spun out to then have that cash returned to them. And now there's another delay on it. I think that's probably what's taken some of the froth off the share price.
Yeah, and profit taking, I think, as well, because again, if you zoom out a bit on the chart, it's had a very, very good run, hasn't it? And then, usually it takes an outperform announcement to propel it onto another leg upwards. So, but I'm certainly no expert on the sector at all, but I couldn't see anything obviously wrong in today's announcement from it. So, I quite like it. I think it looks quite good.
Good. We've got Richard Leppington. He's asking about pets at home. He says he's underwater on it, and he's asking, should he stick, hold, or buy more?
Well, that's entirely his decision. I can't. But what I'm doing personally, I've held it for a while. I'm very happy with it. I think, again, this was another one where the market completely overreacted to a profit warning that was absolutely trivial. They basically trimmed 1% off the expected revenue growth in H2. And again, what you've got with pets at home is that the majority of the profit actually comes from the vets division. But it's hidden within what people perceive to be a retailer. So I think there's a fundamental mispricing of this share. And you could see, look, it's come down from 270, 275 down to 220. Basically just on a very minor softening of consumer demand. So I think if for me personally, I'd be topping up my position. I wouldn't even consider selling it, because I went through the most recent numbers and they're absolutely fine. It's a lovely cash generative business, capital light model, no structural debt, excluding leases. And again, I think you get a 5% plus dividend yield. So I think it's just one to be patient with,
Yeah. So just in terms of the selection, I mean, obviously, if you like the veterinary practice side of pets at home, did you consider buying CVS Group instead, or was you just
we've compared these before, haven't we? The problem is CVS has got a lot of debt. Pets at home hasn't got any. CVS is on a higher PE ratio. Pets is on a lower PE ratio. So just on the value metrics, I think Pets is much better for me personally. But obviously, CVS has a pure play vets rating, which is higher, But I think some of the parts of Pets at Home there's a lot of hidden value there. So I go rummaging after the value rather than the higher rating. But CVS shares have performed better. So your choice, certainly in the short term or medium term, really has performed better than mine. So and the CMA Vets inquiry, the Competition Markets Authority thing, is still rumbling on, but it looks to have been largely neutered. It doesn't seem to have really. It doesn't seem to be perceived as much as a danger to either of them, does it?
Yeah. I think that report actually is coming out in September, so we should know in a month and a half's time. That's for sure.
Yeah, the market doesn't seem to be worried about it.
No, it doesn't. No, and it shouldn't be. You'd hope the government won't destroy, another industry by over-regulating it. That's for sure. Okay. We've got Colin. He's asking about it in a power converter business, XP Power, that's been again through its own trials and tribulations. Came out with an interesting inline statement this week. It was only in line, but the shares shot up because people were expecting it to be. Yeah, and they bottomed out at about £6.50, and they're now over £10. So they've really come back. Some quite astute fund managers are in this one, and it did receive about a bid of about £19.50 round about 2 years ago, I think.
It did, yeah. I was checking, but because I just remember now. We look at so many companies. This is the trouble. It goes in one eye and out the other ear. But XP Power, I looked at it yesterday. It rose 7%. This was H1 results. Now it's basically only reported. It's trading around break even. This is the problem I've got with it. It only reported 0.8 million PBT in H1, and this is for a company that's valued at 250 million quid. So it obviously doesn't stack up at all on the current run rate of performance. But what they are saying is that they've done 5.5 million cost reductions. The order intake in H1 went up 28%. And I remember reading the narrative, and they're talking about a lot of signs of improvement. And so it's a recovery. It's a recovery story. But you see, the trouble is, again, this one's got too much debt. 1.8 times is a lot, I think, particularly when it's not trading well. It's got a strange item on the balance sheet called £47 million bond receivables that jumped out at me. I don't know quite what that is.
Wow.
That's that's a big number on the balance sheet. So I'm just flagging to people to have a look at that. Yeah, I've just basically said I have no idea how to judge it. So it could be a turnaround. It might not be. So it goes in my don't know tray, I'm afraid.
Yeah. No, it's certainly benefiting from a lot of secular tailwinds. I mean, you've got electrification, it serves a lot of the chip equipment manufacturers, data centers, healthcare, and I think it's got very good technology. And they did used to make very good profit margins. They're only making about 8% at the moment, but those are trough earnings. Anyway, interesting, but yeah, it's certainly
too difficult to assess.
Yeah. Okay, good. Let's move to let's go to building products company. Travis Perkins came out with an inline statement this week, but I think the shares went up actually again, just because they thought it was going to be worse. But they talked about I think they talked about it was still any big discretionary purchases were still pretty soft. But what's it called? Basically, their tool station business was doing okay.
What's the ticker on this one, Paul?
Yeah, TPK. Sorry,
TPK. Yeah. Now, I hate to say it, but this was one of the ones that slipped through the net. I didn't actually get around to looking at this one, but yeah, it was yesterday or the day before. But I do recall it went up 5 or 6% on the day. So yes, and we previously liked this. I've just called up my previous notes from May. And I was amber green on it, which is 4 out of 5 star. This was the one where they got in a new CEO, didn't they? The former CEO of SIG and Grafton.
That's correct. He's come.
It's got a good, strong balance sheet, so I like that. Very little debt, only 0.6 times in May. So yeah, I'm sorry I can't really add any more value on this one because I didn't look at the latest update, but I think previously we quite liked it. So I would say, yeah, have a look at it.
Yeah, good. Okay, let's got a couple of people asking. We've got Drew and Harry Sharani asking about MSI International, which I think came out with, it's basically that engineering business with a niche sort of defense armaments division, I think. What was your take on MSI International?
Well, this is very current because the RNS came out at about 11 o'clock today.
Oh, was it? Okay.
Yeah, but thank goodness I looked at it because I do hold some shares in MSI myself. It's 4 divisions, basically, none of which are particularly interesting, apart from the defense division, which is going great guns. With the puns are coming thick and fast today, aren't they? So yeah, it makes huge guns for American warships, amazingly. The barrels rather, and I think it's also big in drone warfare, which of course is a very hot area. What the AGM statement today said, it didn't really give an overview, but what it basically said is they've received a higher offer for the 3 non-core divisions. Now, I didn't know they were even trying to sell them, but they said there were a number of parties interested, and one of the interested parties had raised their bid higher, but they've rejected it again. MSI has rejected that bid. Now, what I'm hoping, and I suspect other shareholders are hoping, is that management will sell off all the non-core stuff for the best figure they can get, and they're doing the right thing, aren't they? Playing hard to get. That's the way to get the price, the best price. They said there's quite a bit of interest in them. It does the canopies for filling stations, which sounds very niche, but it's growing because of electric cars. It does the prongs on the front of forklift trucks, and it makes those in wrong term, but whatever. They make them in America, and they're saying they're now benefiting from the fact that they manufacture in America because of tariffs. So that division's doing well. And then the third division, it's something in Holland, some brand development thing that finally has moved from losses into profit. So basically, they said all three of the niche divisions are now doing better. They're all up for sale. And you've got this lovely defense business that seems to be going from strength to strength. So I think it looks very interesting. Nice, strong balance sheet. It's owner managed. And the guys running this have been running it for about 40 odd years. And they seem to just, according to people I know who've met them at the AGMs, they absolutely love it. Do you know what I mean? It's their life. But, you know, they're in their mid-70s, I think. So they're going to want to sell at some point, aren't they? And we did very well, if you remember a few years ago, on Avesco, which was a similar thing, where they straightened it out, prepared it for sale by offloading the non-core stuff, and then got a fabulous price for the core business. And I think MS International is a similar sort of ilk. So yeah, I like it. I like it a lot. So that was a nice little update today.
Yeah. What's the sort of sum of the parts on it? I mean, if it's trading at currently £12.60.
Don't know, Paul.
Don't know. Oh, okay.
Sorry.
All right. Let's move to stay in the same sector. We've got Senior Group, which basically has done also, is doing an unbundling. It's just sold its aerostructures business. And now is left with its Flexonics, which sells sort of like fuel lines, I think, and different parts into commercial airspace, into the defense sector, plus into industrials and trucks and stuff like this. Shares have recovered quite a bit. And what's your take? I mean, is it going to be? Obviously, it is supplying into the defense sector, which is a very hot area, as we know.
It is, yeah. I mean, we were very positive on the disposal news. This was the one where I remember the disposal was sort of pending for a long time, and they didn't tell the market what the ballpark amount of money was going to be. But when the announcement finally came out, it was very good. I thought they got a really good price for it, and the bit they're selling was actually generating small losses. So, and they got something like 200 million quid for it. So I think that was a really good deal. But the shares have had an excellent run. And when the H1 results came out this Monday, I couldn't really see much further upside. It was on about 20 times. The balance sheet's pretty ropey with too much debt. But when the disposal completes at the end of this calendar year, that should straighten out the balance sheet. And I think they said they're going to do a 40 million buyback, which is about 5% of the market cap. It was an inline update for H1 and in line with full year. I would say it looks a nice business. By my assessment, probably priced about right.
Yeah.
What do you think, Paul?
Yeah, I'm with you. I think it's got some good, again, secular tailwinds, aerospace and defense, good industries to get into. But it's trading on, well, I'm just trying to look at it actually, roughly 17.5 times PE for my adjusted once they've sold the aerostructures. So you're right, it's not exactly screamingly cheap, but
that's right. Yeah, it doesn't jump out as cheap, does it? But not expensive either. Yeah,
good. Okay, let's move to an engineering company we hardly ever talk about, small one, Mincon, which basically does drilling equipment to the construction and the mining industry. I think largely for things like steel and copper and stuff like that. But what's your take? I think it's owned by a family, isn't it? Also, it's sort
that's
of
right. Yeah. Is it Purcell? I think
that's it. Yeah, Purcell. Yeah.
It's Irish. We quite like this actually. When I saw this report yesterday, again, a busy day yesterday, I said to my colleague Dave, I said, I think we like that one, and we have this big spreadsheet with all our previous comments on it that we can look up. I said, why don't you have a look at that one? So he wrote up a section on that. I'm just trying to find it here. Yeah, we like it. It rose 8% yesterday on H1 results. Now, it didn't make that much. Oh, profits grew quite a bit, but only to 4.1 million euros in H1. They've got some big contract called Greenhammer, which apparently is not in the forecasts. It's got a very strong balance sheet as well. So we think this is quite interesting. It's illiquid. It's one of these margin improvement turnaround type situations. I think it's basically had a fallow patch for a year or two where there's been a bit of a dip in the order book, but they said, quote, we look forward to brighter days ahead, unquote. I know, talk's cheap, but we think this is worth people having a look at. I don't pretend to understand the business or the sector, but just on a desktop review of the numbers, I think Mincon is worth people having a look at.
Yeah, no, I mean, if they can increase their margins, they're about 6.5% at the moment, and if they get that to 10%, then you'll see a huge increase on the operating levels, huge increase in the actual EPS. So
yeah, I mean, my question, maybe one of the readers who knows the company better than I do can answer this, or maybe you can answer it, Paul. You would have thought, wouldn't you, heavy duty engineering equipment for use in mines and I suppose drilling, I don't know, all that heavy equipment for the resources industry. You would have just thought the Chinese would have cornered the market. So I think these guys, Mincon, have got some special IP. Does that ring any bells with you?
Yeah, I wouldn't know. I think I think 50% of their sales or near enough 50% are in the construction area. So there must be a big infrastructure.
Oh, are they?
Yeah, it must be a big infrastructure play, with all the new build.
Okay, maybe I've got the wrong idea then. I thought it was all natural resources shares, but yeah, I don't know. But whatever they've got, there's something maybe interesting there, I suspect.
Yeah. Good. Okay, we got Tony's asking about Bango, which I think you own, don't you? I know we talked about it. It was had a trading update. Was it last week? And I think it looked as though everything was moving in plan, particularly with that digital vending service, isn't it? Which they do.
Yeah, no change to my view on that. We haven't written about it in the last few days. So yeah, I've tucked away a few of them. Not a core position, just a sort of medium-term thing. But it's one of these carrier billings. Was this the one where you and I had a chat with the management? I think we might have.
Yes, it was. Yeah, we did. Yeah.
Well, I like the story. I think it's one of these concealed growth things where you've got a growth business that's buried amongst sort of runoff of legacy contracts. So it's not obvious what's going on at Bango, but when you rummage through the detail, you think, oh, actually, this is quite interesting. Strong organic growth in the digital vending machine thing, and good commercial drivers for why clients want to use it, because the carriers find that by bundling services, subscription services together, using Bango as the payments platform, they get much greater customer loyalty. So obviously I'm just taking management's word for all of this. I don't know the sector, but I think it looked risk reward and it looks quite good. Did you pick any up, Paul?
Yeah, I mean, I know I've done some of the parts on this one, and I thought their existing payments business, which is the carrier billing, is worth about the current share price. And then if the digital vending comes off, then it'll be another share price on top. So I think you could definitely double your money over a 3 to 5 year period if that investment thesis comes off, because that digital vending is excellent.
Did you buy any yourself though?
I haven't. No. I bought Eagle Eye instead.
Okay, fair enough. Yeah.
Okay, good. Just mopping up some questions. We've got Luke. He's asking about Xaar, which I think is the digital printing business that's been around for ages and went through trials and tribulations. And I think its sort of USP is that it can print ink, high viscous ink, onto things like T-shirts and stuff like that. But I don't know. I don't think it's come out with any. I haven't seen a trading update recently, but Yeah, go on.
Yeah, that's right. There hasn't been anything recently on that one. I'm in two minds on it. A lot of traders followed Richard Crowe into it.
Yeah.
Now, he does know the sector very well, because I think he used to work in printing, publishing. So, he makes a very interesting bull case for it. I felt, and it does have, I think it's still got cash on the balance sheet. It could be interesting. The story about the 3D printing stuff has been around for donkey's years, though. And the shares have basically doubled from the lows, the recent lows in February, March. So I think for the time being, I'm happy to just sit on the sidelines on this. I don't have a strong conviction either way on it, really.
Yeah. I mean, the shares have doubled, haven't they, since their April lows? So yeah, it's really, I would say this is just to wait what the trading statement says and see whether they've got some further momentum in the shares going up. But yeah, okay, we got Brian. He's asking about James Halstead, which is the commercial flooring, which I think they did. They're seeing some good growth out in Asia. I think they are, with their with their normal sort of like flooring, but they're softer in Europe with their luxury floorings.
Was it? I can't remember exactly. Yeah, I hold this personally. I love it. I think it's great because family owned, family managed, bulletproof balance sheet, with about 64 million quid in net cash That was at December 2024. Pays all its earnings out almost in divvies. So you get a 6% plus dividend yield and a strong balance sheet and high margins. It's getting a boost from US tariffs because it can sell into the US on the 10% tariff that the UK has. It's a UK manufacturer, whereas its competition will be paying much higher tariffs. So this is a case of where actually a UK manufacturer is going to benefit. I think if we're patient on this, it should do very well. You know, it's making about a 20% operating margin. So what they're doing is they're just saying, okay, demand is soft because of tough macro. So we're not chasing after business by discounting. You know, they're just running it for margin, which means that profits are pretty resilient. And it said, here we are, the last update, 29th of July. This was for June year end, June 25, slightly below last year's record profits. So, I mean, you can't complain at that in tough macro. So my take on it is you're getting this at a reasonable price now at what are probably subdued market conditions. So you got all the upside in for, you know, perpetuity really in for free. So yeah, I really like it, but I'm not, I haven't managed to persuade many people to follow me into that one. Not that I try to persuade them, but we discuss it with, you know, all the members of my Substack, and there wasn't a lot of interest from the wider readership on this one. I don't know why, because I think it's a really good quality business. It's not the sort of thing you'd buy, is it, Paul? Really?
No, the flooring business, but it does have a lot of USPs, and I think it's actually got, you know, it's got a very good history, and the heritage means a lot when you come to supplying hospitals and schools and stuff. And it's one of those things is it's that if you get it wrong, it'll cost you too much to take the floor up again and to relay it, and the timings you have to do it during, you know, basically set periods like, you know, school holidays or hospitals getting renovated. So it's one of those things that I think people just go back to what works and has always worked. So I think it's super hard wearing, isn't it, flooring? No, I like it. I think but again, this one's one of my long-term things, so I'm not really interested in the short-term share price. Doesn't matter. Good. We've got Andrew Davis. He's asking about liquidity. How do you actually measure it in a stock in terms of whether it's appropriate?
Liquidity. Well, I suppose just the volume bars, you know, that show you how many shares are traded each day. You can just see from that, can't you? If it's, you know, 100,000 shares or less in a typical day, and it's say £1 a share, then that's not going to be the easiest thing to buy and sell. So yeah, I just look at on the share price chart, you know, where it has underneath it the volume bars. And also the quoted bid offer spread as well. Although you then look at the trades to see what the actual spread is, because of course it's usually narrow, isn't it? And you can look at the trade list each day and see how many shares trade. So you just put all that together, don't you? How about over to you?
I mean, I'd concur with all of that. I'll just add that you usually measure it in a sort of percentage of your portfolio. So if you wanted to put 1% of your portfolio into stock, how easy is it going to be? And if it's going to take you like 4 or 5 trades, then if you're going to put 5%, it's going to be really painful. It's going to take you a long time, and once you're in, then it's going to be really tough to get out as well. So
no, that's the bane of my life, because I have this tendency to go for speculative nano caps, because we all want a 10 bagger, let's be honest. But I don't go for the crazy stuff. I go for stuff with decent balance sheets mainly. And sometimes I spot something else and I think, I've got to buy some of those. And you try and sell something and it just says no market quote. You know, you can't get a bid at any price. So it can be very frustrating, like the liquidity.
Good. We've got one final question. We've got Quest Aware. He's asking about Manx Financial Group, which I never look at, but I was just picking up the shares. And from their April lows, they've doubled. They do financial services in the Isle of Man. The ticker is, what's the ticker? I've got MFX.
MFX. You remember the ticker? Well done, Paul.
Sorry about that. Yeah,
that's all right. I've been nagging him constantly. Readers. Manx Financial last reported on 24th of June. I had a quick look at it. Oh, that was nothing. That was just change of regulatory permissions. So Jim Mellon owns 18%.
Right.
It had good growth last year, but there are no forecasts in the market. It's just a tiny little bank. I don't think there is good profit growth. So I can see why people would like the. And it said, when was this? On 12th of June, it said it anticipates 41% profit growth to 9.9 million PBT for the that must be calendar 2025. The trouble with these small banks is it only takes, or the big banks as much, with any bank, it only takes a big change in the macro conditions and all the bad debt provisions have to be rejigged and your profits disappear and you've got a thumping great loss. So, I mean, I don't invest in banks at all. The only one I think I've ever invested in was that OSB, that savings bank thing, and that did quite well, actually. But generally, all the banks are cheap, and I think they're cheap for a reason. They've got these very, very weird balance sheets with gigantic credits, gigantic debits. So it doesn't take much of a change or something to go wrong to cause a lot of trouble. So no, not for me.
Yeah, the banks actually have done very well, haven't they, over the last sort of, you know, they've recovered hugely. I mean, and they're not that cheap now because you've got Lloyd's, which has been trading at a material discount to net tangible book, is now 1.3 times net tangible book. So
and there's on a P of about 10. And I did have a quick look at, I have looked at a couple of the big banks' accounts recently, and it's really striking considering we hear about how, business confidence is on the floor, you know, consumer confidence is shot and everything. Well, the banks are getting negligible write-offs, you know? So you would think, wouldn't you, they'd be having to make massive provisions for bad. It's the opposite. It seems to be the case that actually borrowers, you know, the situation's far more benign than the general commentary seems to, in the media, seems to be. And I think they're doing a lot of damage. I was talking to a corporate finance manager for a large cap, and he said to me, when he talks to overseas shareholders, they just read the British press and think the narrative about Britain's almost bankrupt. They just take it as read. You know, so the press are doing so much damage, and most of it's rubbish. You know, if you look at the debt to GDP, Britain's nowhere near as bad as plenty of other developed countries. And so I really do think we've got to stop undermining ourselves as a country.
Yeah, it's quite interesting, isn't it? Because we do have a lot of conflicting data, because you have one business sentiment survey one day saying it's really negative, and then the next day they're saying actually it's on the up, and likewise. You know, it's sort of the housing market's supposed to be on its knees, and obviously the share prices aren't doing it. But if you get interest rates coming down, then that might change it. And then you've got the tariffs that some of the UK companies, because it's only 10%, as you rightly point out, like James Halstead, then they're getting an uplift as well. So you are getting a lot of. It's quite difficult to sort of like grasp where we are really, other than we're just sort of like you know being buffeted by a lot of sort of crosswinds.
Yeah, I think that's spot on. That's exactly my. That's why personally I'm not trying to read too much into the macro. And of course, as somebody said, there was one of the press articles. I mean, like you, I'm sure I read all the press is saying about the latest data and everything. One of them was saying actually the cut in interest rates is going to take more money out of the economy than it'll put in, because of course savers. So many people have got savings now. The savings ratio is high in Britain, and they're going to get less money flowing in. It probably won't make any difference at all to consumer borrowers, although highly geared corporates will benefit from the interest rate cuts, won't they? But we're expecting a quarter of interest cut tomorrow, aren't we?
Yeah, that's right. Yeah.
And then there was, who was it? Was it one of these think tanks was saying they reckon Bailey might cut interest rates six times over the coming year.
Bloody hell.
Because the bottom's falling out of the labour market, and the factors that caused our higher inflation are well known and are transitory. So I don't know. It could all be looking rosy again in 6 months' time, with lower interest rates and the housing market picking up and everything. We've got to try and anticipate this, haven't we? That's the thing. So I'm leaning probably 60-40 towards being bullish, actually.
Yeah, it is very difficult to sort of like put a nail, you know, or put your flag on the pole and decide exactly what's going to happen in which particular areas. But if you buy good value, good quality companies that have been through economic cycles before, then more than likely they're resilient, and they've got that muscle memory that they can get through even tough times if you're wrong on that overall macro thesis. Yeah,
I mean, it is incredible what companies have had thrown at them in the last 5 or 6 years. I mean, it's just been one thing, crisis after crisis. So, which makes me think, you know, well, actually, if we do get back into a more steady state of sort of normalized economics with a bit of growth and lower inflation and lower interest rates, you know, a lot of these companies, having stripped out all that excess cost, rationalized, producing good profits in the hard times, they can have massive upside, some of these things.
Yeah, something a good place to finish on. So
yeah, nice positive optimistic note.
So thanks everyone for your questions. Thanks again, Paul, for your insights. Now next week, myself and Paul are speaking to Treat, the flavors business, I think Wednesday afternoon.
Yes.
So we'll have the call at usual time, 2:00 on Thursday, next Thursday. So
yes,
look
back
forward
to Thursdays.
But back to Thursday. So thanks again, guys, and see you next week.
See you next week, everyone. Thanks, Paul. It was good fun as always.